My name is Harshul Ganjawala, and I'm a Senior Capital Markets Associate at SAP Capital. Last week, I spoke at the InterFace Net Lease conference here in Manhattan. The consensus across the panel and with the investors in the room was the same. Interest rates are high, deals aren't penciling. So we discussed what we were working on, what worked and what didn't. Just for financing purposes alone, outside of what everyone is watching, which is the Fed funds rate, there are three other factors that are integral to yields moving forward. Quantitative tightening, which is essentially the Fed allowing bonds to roll off of expire off their balance sheet, which decreases the supply and increases yields. Second, inflationary pressures that continue to persist. And third, the federal government continuing to print money, i.e. issue more bonds, which ultimately drives up yields as well. All three of these are very important factors to keep in mind and keep an eye on as we go into 2024. 2023, for the remainder of 2023, the Fed is expected to raise interest rates one more time. However, with the 10-year Treasury today being close to 5% at 4.9, as well as other treasuries following suit, it's going to be a month-by-month. It's going to be a month-by-month observation and or analysis the Fed is going to conduct to see if they're ultimately going to raise rates. Going into 2024, the consensus is that we may see rate cuts into Q3 and Q4 of 2024. 2023, we may or may not see one more rate hike to the Fed funds rate, which ultimately is going to dictate how investors see the coming year. What I saw at the conference is many investors think it's going to be a lot of the same in next year as it was this year. Some interesting points that I came across were that institutional investors aren't looking at deals below a 7.5% cap rate. This is mainly due to the long-term outlook. Investors over the past couple of years have been yield driven, and with interest rates as low as they were, cap rates also remain low. Now that cap rates are not moving as much and interest rates continue to rise, loan to value ratios have also come down. Banks have also tightened up, meaning their debt service coverage ratios are higher than they once were, as well as many more covenants being added into loans. Couple all of this with the fact that 1031 capital is starting to dry up due to the lower amount of transactions taking place. And hopefully we see a market where cap rates start to expand, which means that higher interest rates can now support the types of can start to support investment grade transactions like we've seen over the past couple of years. Another very interesting point was developers working with tenants. Tenants that are continuing to expand their footprint are now finding ways to structure more landlord-friendly leases, which means more increases, whether it's on an annual 5-year or 10-year basis, less termination clauses, and overall just finding a way to make these deals not only pencil for them, but also attract more investors, whether it's institutional or it's small mom and pop, family offices, and the such. Those are the main takeaways for me at this year's conference. If you have any questions, feel free to reach out to me. I'm happy to go into more detail as to what we're seeing in the market, the kind of deals that are working for us, what isn't working for us, and ultimately what we may be able to do. Thank you.